Perfect, perfect, perfect. All right, let me get some tweets out. Let me get some people going. We're going to get the stream loading image up so that I have a little bit of time to do this. Learn to trade. Post. Keep it easy. Keep it nice and easy. All right, we got that here. We got that muted. Let me get my chat up so we can see what people are saying in the chat. Let's talk. Keep it easy. Let's talk. Keep it. All right, let's go here. Hold on. Sorry, I just got to find the. There it is. There it is. Well, now we are officially in the chat for both of these. All right, cool. Well, some of you guys maybe have seen what we've been working on, what we've been cooking up. This is a massive shout out to Crypto School and to Kyle Dupes, who created this course. Crypto the Kid, he obviously has been dropping a lot of alpha in the Telegram, and it's all really built around learning to trade and understanding how to trade. And I think that that's a superpower that I would love for all of you guys to get. And so I was trying to figure out a good way to really be able to break this down and really bring more people into trading. Obviously, trading memes is fun, and that is a place where you can make a lot of money. And many of us have made a lot of money. But if you can understand, if you can read charts, if you can look at things and understand ranges and understand risk management and understand things like that, you're going to do even better. So without further ado, the connection right now is a little bit wonky. I'm not sure why the connection is bad, so hopefully you guys can hear me. You'll let me know in the chat if you are not able to. But if you are, then I think we're good to go. So I'm going to chop this up. I don't know how many courses this has. I think it has quite a few, and Crypto the Kid swears by it. So we're going to check it out. This is Whale School by Crypto School. They have a relationship, of course, with Crypto Banter. And we're going to go through it together. I'm going to take some notes. We're going to ask some questions. And we're going to be able to become better traders, all of us. So here we go. You guys are seeing it for the first time with myself as well. All right, so that was the first course, which was kind of just like the introductory course. So how it works is it looks like they have it really built out in a nice way, like it's sequential. You get the first thing, hey, here's the welcome, here's what we've done. The welcome was essentially just about, thank you for signing up for the course, and here's what you're going to learn. We could actually watch that together while we let this kind of play. I think that we can go back and see it again.
Congratulations, you just took the very first step. Now, most of you here are probably here because you want to retire, you want financial freedom, you want to quit your job, you want to pay. You may be wondering, how is a 2,000?
I think I accidentally skipped the first one, but this is what it's gonna like kind of look like.
You just took the very first step. Now, most of you here are probably here because you want to retire, you want financial freedom, you want to quit your job, you want to pay off your debt, and ultimately you're looking for a way to completely revolutionize and change your life. Well, you're at the right place. And
all right, so I'm just giving you that to give an example, to get some of the audio right. Essentially, everyone's going to be here for a variety of different reasons. We've obviously seen much of this, and we'll see it again. Let me drop this into the Telegram so that people can join. So that people can join on in. I'm going to do it from YouTube, actually, is where people can join, because YouTube, I think, is just a little bit better than X. Join the trading session now. Boom. There we go. Everyone's in. All right, so that's what we're going to be looking at. I think we've had a good enough introduction.
More importantly, you're here at the exact right time. I'm about to tell you how and why you're going to become part of the top 1% of traders in the world. Not so long ago, during the pandemic, I lost everything. 1%. Absolutely everything. My entire career was thrown upside down. Well done. Now that you've submitted your user ID, you're well on your way to accomplishing your trading goals. I'm excited to guide you through the next steps of.
Let's watch this part here. It's the next steps of our trading thing. This is how we'll become part of the 1%. Trust me, believe it or not, it's not that hard to become part of the 1% because the other 99% are off chasing butterflies. So here's how we're going to do it.
Whale School, and show you how this course will help to mold you into the top 1% of traders worldwide. Whale School has already impacted tens of thousands of lives, but only a select few managed to change their lives forever and form part of that top 1% of traders worldwide. Do you want to be part of the select few? Well, our students who have gone on to become master traders have a few things in common. Firstly, they finished each week's lessons before the live workshop events began. These lessons are where I'll teach you to trade like a pro, using personalized trading strategies that...
So for those of you who don't know, this is Kyle Dupes, really cool guy, very genuine in the space. And I think it's cool that they have the courses first, and then they have the actual live cohorts that you can sign up for.
Are suited to your trading style and your schedule. You'll learn advanced risk management strategies which only a small minority of traders know and use. You'll learn how to see price action from a market maker's perspective, which means that you'll understand how to trade in line with the smart money. By the end of this course, you'll be able to predict future price action movements with a higher degree of probability than any other time before. Now, for a better learning experience, I recommend using a computer or a laptop to go through the lessons. However, if you do want to use a mobile device, it is compatible and you can do so there. Finally, in order to make it through to the master trader status, make sure that you attend each and every single workshop. You'll solidify your learnings. You'll have a chance to interact with me one-on-one, ask all the relevant questions that you may have. You'll also receive access to additional alpha and educational content that was reserved specifically for these events. It's the extras that take you the mile further within your trading journey. You'll also have a chance to participate in exclusive giveaways and join the Discord community. And here's the real kicker. You'll make like-minded friends and meet with traders who you'll have a relationship most of the time that will last you years. And that's where you really catapult yourself.
That's a good point here. We're gonna skip ahead because I want to get to the course material, but that's a really good point around finding like-minded individuals, because you want to be the person who is soaking up information in the room. It's tough if you're the smartest person in the room, man. It's really tough to make money. But if you're finding like-minded individuals like yourself, that's a area where you can like really learn, and your learning will expand. One of the
promises that we made you is that you're going to
like tenfold. So let's get into it.
Like-minded people and create a network for life. Well, there's an opportunity for you. One of the most exclusive, high-value ways to do this is going to be in Whale Room. I know many of you are already in Whale Room, but for those of you that are not or have recently joined and you don't know what it is, what is Whale Room? Whale Room's our private Discord where all of us come together as a community with like-minded people, and we have professional traders and coaches there to assist you through your trading journey. They help you take trades, they give you signals, and they help you to read the market.
It's never bad to get information from really smart, talented people who've been there. I know that Crypto the Kid is in this Discord and he speaks very highly of it.
Through the ebbs and flows of the market cycles and lead you into financial success. Now, because you're part of the Whale School community, we have two amazing and incredible offers for you in which you can get into Whale Room. The first way is you have your 14-day free trial. Because you've gone through the course content, you automatically have a 14-day risk-free period where you don't have to pay one single cent, and you get access to every single benefit and feature that's in Whale Room. You can see for yourself if you like it or not, and then make a decision after that. And the second way is an amazing fire sale that will be the best offer that you'll ever see when it comes to joining Whale Room. It will give you the access to the best possible price point. So take advantage. All the information will be given to you straight after this video. I look forward to seeing you not only in Whale Room, but also in the rest of the Whale School course. So have fun, and I'll see you on the other side.
All right. So far they're talking a lot about, obviously, making sure that you're getting signed up in the right places. One-time free offer, one-time free offer, you get 3 months free when you purchase only now. We already have some of this, so like I'm going to skip some of that. But I think that that's a valuable thing. Of course, being in a Discord like that can really help accelerate your learning and accelerate your ability to trade. I am already in. So there we go. Yeah, we're gonna have to go through some of this stuff. That's okay. So it's a course. I want to make sure that, you know, Kyle's getting some love here as well, because we're streaming the course, and I want to make sure that, you know, what he wants shown is shown. And I was able to chat with the people at Crypto School, and you know, that was the agreement that we were able to hammer out. So I'm excited about this section. This is going to be our first learning section. Risk management. Risk management, 39 minutes long. So lock in. I'm not sure we're not going to do this whole thing today. We have risk management. We have support and resistance, candlesticks, chart patterns, ranges, trends. There's all sorts of good stuff here. But risk management is something that I would say degens are notoriously bad at, because, hey, it's their superpower, but it's also their most difficult quality. They don't feel risk, right? But this is where my poker background really comes in. It very much is a game of probabilities. I can't wait to see this, because this is right up my alley. Bankroll management, risk management, making sure that you don't ruin your bankroll. It's so important, so extremely important, because if you lose all your money, you're out. It's over. It's GG's. You cannot make it happen, right? So I'm excited to see this part about risk management. If there's one skill, and I'm glad it's the first course, the first piece of the course, if there's one thing that you have to learn to be able to make money in crypto, in TradFi, in any world where when you have to make decisions under uncertainty, risk management is going to be there.
And in trading, you can never be absolutely certain of where price is going to go. And this is why risk management is one of the most fundamental and important things that you need to have in your trading. There hasn't been a single trader that stood the test of time and lasted with endurance without having risk management as part of their toolkit. What is risk management? Risk management is not only knowing when to bet, but more importantly, how big to bet. It's one thing to make money, but it's another thing to keep that money. Because markets move cyclically, there's periods where it's very, very easy, and other periods where the market chops around and it becomes increasingly more difficult to survive. And in order to thrive, you first need to know how to survive. And if you can survive that choppy period, and you can still...
This is why when we talk about taking profits, I talk about taking profits all the time. The reason why you have to take profits is to survive that choppy period. It's easy when everyone is euphoric to think a project that is going from 1 million to 5 million, that it's just on a straight upward trajectory to $1 billion. And by the way, everyone who is anyone, or maybe even not anyone, will tell you that that is going to $1 billion and you need to diamond hand. That might work. But when we're talking about risk management and we're talking about probabilities, it is super important for you to walk away from that trade, a winning trade, not even a winning trade, a trade you have won. It's important for you to walk away with money in your pocket to survive that choppy period or a down period, because if you don't, you will round trip everything.
You'll be well enough positioned to make lots of money. This is why you hear so many different stories of people coming late into the crypto markets who said that they were up $100,000, $1 million, $10 million, but before the end of the cycle occurs, they've lost absolutely everything. The age-old saying when it comes to trading and investing is you need to cut your losses as quick as possible and let your winners run. And the saying could not be more true. The longer you go through this journey, the more that saying will start to stick into your mind. And this is why when you look at something like poker, which is a gambling sport, you still see people make a profession out of it and turn it into a career. And the reason why is because they're expert risk managers.
Did he say poker? Did he say expert risk manager?
Know exactly when to fold their cards, and they also know exactly when to go all in. A poker player has
the good players.
Influence into what hand of cards they're going to be dealt. But what they do have an influence in is how much they're going to bet and whether they're actually going to...
I kid you not, I don't mean to derail this, and I know that you guys probably want to see this just like straight through, but from a poker perspective, that's where I get a lot of my transferable skills, from the poker markets to the crypto markets. I actually got into crypto through a lot of the people who I spoke with at the poker tables, sitting there long hours. If you are a good poker player, you can talk to another poker player and you know how good they are almost immediately. You just talk them through a hand. You hear how they speak about hands. You hear how they think about hands. You hear how they think about results. And very often, everyone plays poker more or less. They'll come up to you and they'll say, can you believe that this happened? And if they do something like that, you know for sure how good they are. Usually not very good, because you say, yeah, of course, I believe that happens. Happens all the time. It happens 15% of the time. It happens 8% of the time. That's a lot of the time. So shout out to Kyle for giving us poker players
take the trade. And this is exactly the same thing when it comes down to crypto trading. You need to know exactly when to bet big and when to step away and not take the trade. In this lesson, we'll cover each and every single step required for you to succeed when it comes to risk management. And I cannot emphasize enough how important this lesson is. If there's one thing you take from this course, let it be risk management.
Oh my God, preach. Kyle already making it happen, man. Risk management being the foundation of everything. Take your profits, boys and girls.
Money tends to flow from weak hands to strong hands. And my experience with money has been that it's slippery and hard to get. And what I mean by that is when you're poor and you're struggling, it's very difficult to get money. And when you get the money, it's very difficult to keep the money. It seems to constantly flow. One of the most important things when it comes to succeeding in this journey is going to be protecting your capital at all costs. And part of that understanding revolves around something magical that I found, which revolutionized my trading career. And I like to call this the down death trap. If you have a look at this table over here, the percentage gain required to recover a percentage loss. What this table will showcase to you is the bigger your losses become, the even more exponential the gain required is just to get back.
Hey, pay attention to this part, because some people think if something goes down 10%, all we need to do is have it go back up 10% to recover. But that's not true. Check this out. Look at this chart. Drink this in, because the amount of gain that needs to happen from a drawdown is significant. By the way, it's even more significant in crypto, especially in meme coins, because of the liquidity, because of the taxes, because of the slippage. So this chart can be multiplied in an even more significant way. If something goes down, I see it here, kind of blacked out, 95%, in order to get you back to even, it needs to have a 1900% gain. You layer on top taxes, you layer on top slippage, you layer on top these low liquidity pools, and it's even higher.
To break even. So in most people's mind, they think that if they lose 50% of their capital, they need a 50% profitable trade to get back to break even. But if you have a look at the table over here, 50% down means you need 100% trade, which is double your money just to get back to break even. And if you go onto the right-hand side of the chart, which is where a lot of crypto traders and investors spend their painful careers, with losses from 70 all the way down to 95%. It's not uncommon to see crypto coins go down 95 to 99% in a bear market. Most of those coins will never return. To put this in perspective, if you lose 95% of your capital on a particular trade, you will need 1,900% profit, not to make money, but literally just to get back to where you were before, which is break even. Therefore, if you have a look at this chart over here, it shows again the gains needed to recover from a certain loss. And professional
This is such a cool chart. I'm already liking this. Crypto the Kid, shout out to you for pushing me to do this. Look at this, guys. This is why when people say you got to diamond hand something, diamond hand it. You can't allow yourself to get, if you want to load up, perfect. Load up down here. Load up at down 80%, down 90%, down 70%. But holding something all the way to the bloody bottom and then having it recover, Ethereum, you need such significant gains in order to make your money back.
Traders want to be spending the majority of their time
this is genius.
somewhere within this region over here, capping their losses to, I would say, around 10%, at a push 20%. If you lose 20% of your account, you only need 25% just to get back to break even. This is still possible in crypto, but as soon as you start to cross that threshold and move further down the list over here, you're going to be struggling and fighting gravity, which is towards the downside. If you're a low time frame trader, you typically don't want to be going beyond the first or second bar over here. Most traders are going to be risking between 1 and 2% on each trade that they take.
High time frame traders, you can probably risk a little bit more if you're spot trading, which means that you're just holding the underlying asset. If you're on leverage, you need to be even more cautious when it comes to your risk and the losses that you could incur. Because remember, if you get stuck in a leverage position that's sitting somewhere down here, there is a chance of liquidation. And if price goes any further, you risk losing your entire trading account. Now that you understand the drawdown death trap, you're already ahead of 99% of other people that are just coming into the crypto market. And this automatically by default puts you in.
Be honest. How many of you actually think about something like this when you're opening a trade? I don't think many, because the DMs that I get asking me about projects and things like that, it's not talking about drawdown death traps. That's a good way to put it. I can't wait to use that. It is talking. I hear, man, I bought $1,000 at 1 million in market cap. Now it's down to 100K. What should I do? Is it going to come back? Am I going to make my money back? What type of multiple do I actually? Sorry, I don't even hear the question. What multiple do I need in order to make my money back? They just know that they have an asset that is down 90%. And so what Kyle's saying here is, if you were able to mitigate,
Is that not people that are the losses that
and
you could
I
incur?
apologize for covering up your face, Kyle. I've just got the dude in the bottom left. I don't have a way to put him to the top left, or I would do so. But when you look at this chart, that's why you want to live up here. That is, if you're a very high velocity trader in this area, and if you are a longer term trader, you can kind of creep down here to 20% or so, but you can see it starts getting ridiculous and exponentially more difficult to make your money back. Forget about taking profits and actually being able to buy a house or pay off debt. You're talking about just being able to make your money back. So this is how you should be thinking about trades. And that's why he has risk management as his foundation.
Because remember, top 1%, but make sure that you utilize that knowledge to your advantage and stick to the rules of limiting your losses. Cut your losses as quick as possible before they become major losses, and
have
let
rules.
your profits ride. The next important thing that you need to focus on is protecting your capital at all costs. Scams and cybersecurity attacks are on the rise, and the software is becoming increasingly sophisticated through AI technology, and it's exponentially becoming more and more difficult to counter this trend. So as a trader or investor, it's of paramount importance that you protect your capital. Many criminals will target crypto people because once they get their hands on your crypto, it's pretty much gone for good. There's no way that a bank can freeze any of those accounts. So if they get your coins are gone. And this is your responsibility to protect your IP. One easy way that you can do that is.
All right, hold on. I'm not losing thoughts on the course. Trust me, this is a serious course that we're paying attention to. But what has he got going on back here? Is this his house? Is this the background? He's got a beanbag here. He's got a computer that's kind of open. It's like a hammock with a pillow in it, and then a nice twirly staircase to go up to the next floor, which doesn't seem to exist. So, Kyle, man, I got to come to your crib because this looks pretty awesome, I will say.
Through a VPN. You can use any VPN that's out there, but later in this video, we'll show you how to set up a NordVPN account. And that's because we partnered with them and they provide a massive savings for you, the user. The next most important way to protect your capital so that you custody your own coins is through a hardware wallet. Again, there's many wallets out there like
Get a hardware wallet.
Ledger, Trezor.
Please.
You can use paper wallets. And the final measure that I believe you need to take when it comes to protecting your capital is use a password manager. This is incredibly useful, especially since I recommend you diversify across multiple different crypto exchanges. So you reserve some of your capital to be on hardware wallets. That's going to be your core positions that you're holding for months to years. And then you're going to have your active trading accounts. But to
Yeah, I'll give you a quick way that I do it. I have a few hardware wallets, 3 of them that are my core hardware wallets. That's where my Bitcoin, my Ethereum, for the most part, it's only Bitcoin and Ethereum, by the way, that are my long-term holds. They exist. I will never buy I will never sell from those wallets ever. I will never connect ever. So those exist. I don't care if Bitcoin goes to 20 million. I don't care if it goes to 0. Nothing will ever be bought and sold from those 3 wallets. They exist and they will never change. Those passwords have never, ever been written down anywhere other than in some very secret places that are stored very safely. There's a lot of redundancy built in. Then you do have your active trading accounts. I have Blowfin and a few others, but mostly Blowfin. That's where I like to trade. And that is where, okay, I'll buy and sell. Okay, fine. Then I have some other hardware wallets where there's Bitcoin that I will sell. So this run up in Bitcoin, I will sell that Bitcoin at some point because I think we're going to be able to obviously go through a cycle. Very clearly the cycles are intact. But like that's how I handle it. That's how I handle my trading in terms of like protecting your assets and making sure that they don't cause, you can't get hacked. You can't have too big of an issue, right? But you should really think about wallet security. I have a phone that has never connected to the internet, that I take pictures of some of the stuff. I write it down in notebooks. So there's a lot of different ways that you can do it, but be really careful. I'm paranoid about that. And the worst thing would be for you to make a lot of money this cycle and then click a wallet drainer and go to zero.
Mitigate some of those risks across the various different crypto exchanges. The more crypto exchanges you have, the less risk you're taking, because the probability of having an FTX-like collapse across all the different exchanges simultaneously is almost slim to none. But if you have all of your capital on only one crypto exchange and that one crypto exchange goes down,
BlockFi,
just like we saw with FTX, then you're going to lose all of your capital that's on those exchanges. So
Celsius,
using a password manager will make it a little bit less tedious to monitor all those various different
I don't use a password manager.
login details. And this is your responsibility.
I don't want to get hacked.
In the next video, we'll dive into understanding your strike rate. This will help you to think in probabilities and know what sort of trade setups to look for. I'll see you guys there.
Yo, I'm liking this already. Kyle coming through with a lot of
trading,
alpha.
You'll be looking to risk a certain amount of capital with the expectation of a certain amount as a reward. When you have a look at a chart, you'll see something like this.
Hey, be honest. Do you guys do risk reward? Do you do it? Because this is how you want to think about trades. Risk to reward. What's your upside?
This is your risk to reward setup tool, and it stands for 3-to-1, 12-to-1, and 1.5-to-1. What this simply means is for every dollar that you're risking on the left-hand one over here, you're looking to win $3. For every dollar that you're risking on the middle chart over here, you're looking to win $12. And this one over here, for every dollar that you're looking to risk, you're looking to win $1.5. Now, understanding your win rate will help you to determine what size risk to reward you should be looking for in each particular trade. When it comes to trading, you'll need to take enough trades over time to understand what your win rate is. By understanding what your win rate is, you'll know what size risk to reward tool to look at when approaching your trades. When most traders come into trading, they take a completely randomized approach to looking for certain trades.
So this is something that I talk about quite a bit. There's people who are, especially on the timeline, especially in crypto Twitter, my win rate's 100%. I'm never wrong. Guys, everyone's wrong sometimes. Everyone is wrong sometimes. To say your win rate is 100% is irrelevant. My win rate could be 100%. And if I win 1 penny every single trade, well, unless I am a bot, hypervelocity, high frequency trader, it's useless. I don't care just about what your win rate is. I care about how much money you actively can get out of the trade. That is the other piece of it. He's talking about poker, which I love, by the way. If you tell me I've never had a losing session, oh, wow, how do you do that? I sit down, I play one hand, and I win it, whatever, go all in, which again, I know is stupid. I actually should have went with the chess example here, but let's just say you could go all in, you win every single time, and then you quit, and you walk away $5 richer. Your win rate's 100%, but you haven't won anything. It's useless.
The risk to reward tool. Sometimes it's a 2-to-1 risk to reward trade. Sometimes it's a 10-to-1 risk to reward trade. If you have a look at the following table over here, the reason it's important to understand where you are on that scale is you'll know what risk to reward trade to look for over time, which will make you a profitable trader. The whole point of this is to understand what you need to do to become a profitable trader. If you become a profitable trader, you have a money printing machine and a business that will continue to make you money over time in a very predictable fashion. Now, a lot of new traders will come into the market with a lack of understanding of technical analysis and an inability to read the market. They may be sitting in this region over here, which is they win their trades 20, 30, maybe 40% of the time. Anything under 60% probably means that you need to sharpen your tools and understand technical analysis a little bit better. So
a good question I'd have for him is, what is the sample size that you would need to be confident that you're a winning trader? For example, or to even understand what your win rate is. For example, in poker, if I sat down and played with you, we would need a couple thousand hands minimum for me to be able to determine what ratios are actually valid and which aren't. I can't say that you're a tight player if we haven't played enough hands, because maybe you're just not getting the hands that should be played. I need a large enough sample size to know that you've actually received all of the hands that you could possibly have to understand whether or not you're playing too many, too few, whatever.
Over there, and you're looking for trades that are a 1-to-1 or 2-to-1 risk to reward ratio, the chances of you being profitable are very, very slim. But you can see somebody that does only win 20% of the time, but they've proven that they can do that with a 5-to-1 risk to reward ratio over time would still be profitable. And this is the beauty of trading, is understanding the probabilities. Now, my recommendation to you guys is that the best zone to be focused on is getting your technical analysis skills to a point where you right 60 to 70% of the time. Most professional traders are going to be right 70 to 80% of the time. And then what you want to be doing is you want to be looking for trades that are around
the best
3-to-1 risk
70 to
ratio,
80%, by the way.
Which is going to be in this sector over here. That means that most of the time you're going to be profitable. Whether you're looking for a 3-to-1, a 4-to-1, or a 5-to-1, you are most of the time going to be profitable. But the only way that you can understand what your true hit rate is and which risk to reward you should be looking for over time is to study your trading. And the way that you'll do that is through a trading journal. Building a trading history can only be done.
I think Guardian is someone who does that really well. At least how he describes it. He has a trading journal that he uses, which I think he does a good job with.
By taking actual trades and recording those trades in the form of a journal, you get different types of journals. You can get a paper journal, you can get an Excel or manual journal where you enter everything in, or you can even get
Excel,
an automated
my favorite.
Journal. Whichever journal you decide to use is totally up to you. The point of the exercise is to study your numbers. At the end of the day, the success in trading will come by understanding your numbers, learning yourself, and knowing the details. Just like any other professional business that's out there, they have quant data and researchers which study the numbers and provide valuable corrective measures to get the business on course. This is exactly the same thing. If you have a look at this over here, this is an example of a manual journal. All the links will be provided below to give you an example of these manual journals, but it's very, very simple. All you need to do is record the date, record the coins that you're looking at, record whether you went long or short, what was your entry price, the status of the trade, is it closed, is it still open, were you stopped out, did you take profit at the final level that you had previously anticipated, where was your stop loss originally, and then record what happened in the trade. Was it a win or a loss, and what was your final percentages? If you have a look at the numbers over here of these trades that I previously took, I took 10 trades over here. The average price movement of all those trades combined was 110%. I won 9, I lost 1. That gives me a 90% hit rate. So using these numbers, you can extrapolate a whole lot of valuable information, and you can start to study how and where you could improve.
I know that this might seem like a lot, especially for meme coin traders who are just like, just give me a ticker, let me get in, let it be 2 hours, 3 hours, let it go up, let it go down, and hopefully you've taken profits. If I have to beat the dead horse, I will do so. Take your profits. But this isn't that bad. Like this is not a lot. Look, hey, what time did I take the trade? And by the way, there's automatic tools that will latch into your account and do a lot of this for you. So it's very low effort. And just the fact that you're taking the time to make these notes and learn a little bit is going to put you so far ahead of everyone else. It is amazing.
If you have a look at this over here, I made some generic notes of where I succeeded and where I failed within each of those trades. This is for a shorter time frame trading journal that I was looking at. For swing trading, I used a little bit of a more specific approach over here because it does take a little bit more time. Now you can see over here, I've also listed all the various different dates. I listed the period of trading that I was in, which was 6 months.
2021
trades. I had 7 wins, 3 losses, giving me a 70% win rate. And you can see the capital initially, I started with $25,000 and I built this account up to $40,811. And I've stipulated a whole lot of different factors over here, trade factors.
I want to see, I just want to read some of these and see what they say. It's kind of hard, I know, for you guys because the screen is a little bit smaller. So let's see. What are these trade factors, mistakes? Okay. So it looks like he opened a swing trade here. Type of trade swing, risk from wallet 1%. So he risked $425. Trade factors 50 MA daily on the 4-hour resistance from SBF candle. Break of structure. I'm just zooming in here. Mistakes was consolidating above 200 MA. It showed bullish sign. So I'm assuming that one in row 4 was a short, right? Let's see.
$11. And
row 4, it doesn't say. Oh, he got nuked on it. Oh, he was. Okay, so here we go. So this is great. This is a great example. So I wish that I had a thing that I could highlight this. But so he went short for this trade. Whatever, I don't see the actual token unless I'm missing it again. This all looks a little bit small for me too. But he went short for 1% of the account, which is $425. It was a swing trade type, so he identified that this is going to be a short-term trade. He went and looked and said, "Look,
factors over here.
I got liquidated on the trade. Why? What was my mistake here? The price consolidated above the 200 MA. That was a bullish sign. So even though there were some trade factors that might have made me want to enter this trade and gave me good reason to enter the trade, this is a mistake that I maybe made. It's another piece of evidence that I could have had, and looking back now is very clear. Which, by the way, it's much easier to do that, but many people don't do that. So anything to remind. Let's see if it keeps going here. Here we go. Anything to tell to remind yourself. I told you that you were just lucky. Okay, I don't know if that one is all that helpful. Maybe that's a little bit tongue in cheek. But it looks like he gets really. Oh, this is a whole series. This is pretty funny. Kyle, shout out to Kyle. Look at the things that he's telling himself. Don't think you're an amazing trader. It might just be luck for the first few trades. The second trade, don't think you're an amazing trader. Might just be luck. Then he lost. I told you you're lucky. The next thing that he learned, I'm learning. I'm not lucky. I'm trying my best. Too early to enter. Be patient. Move your stop loss when the entry price moves 1% or more. Amazing manual closing on change of structure. I'm not greedy. You are getting better. Don't think you're too smart. Just stay humble. We were just talking about this. I actually pinned up in the YouTube chat from ASAP8080. He said, you got to stay humble because Steve the Canadian said, I find that whenever I get a little too cocky, the crypto gods smack me back down to reality. And that's a lot of what's here. It's funny. The things that Kyle's reminding himself consistently is that, look, it's all about the process. You don't have to worry about the results. Don't get too ahead of yourself. Don't think just because you've won a few trades that all of a sudden you're a god trader. And so that's interesting that that's what he's putting here. But in column R and S, he's got trade factors that are reasons why he's entering and opening trades. And then he's got mistakes that he made if he feels like he made mistakes.
Anything else that you want to remind yourself on, because this will help you to understand when you're trading your best. Maybe it's a particular time of day. Maybe if you have any sort of emotional problems on that day, it's better not to take the trade. Remember, you need to think of yourself like a professional athlete. You need to be performing at your absolute best and your mindset needs to be right. This is what trading comes down to. It's a psychological.
I know there's like a bunch of people in the chat right now that are like 450 pounds in the mom's basement. They see this dude doing backflips and they just turned it off. They said, I can't do that.
Game. For those of you out there,
you don't have to do the
backflips. A little bit of a more sophisticated approach when it comes to tracking your trades. There is a lot of different services out there that are software oriented, where you can connect your APIs from your various different exchanges, and pretty much will pull a lot of that information and make it a little bit easier for you to track over time. Remember, being accountable is the most important thing over here. So again, whether you decide to use a manual tracking system or an automated one, it's the accountability that's the most important part. So if we have a look at this over here, this is called Edge Sheet. And again, there's many of them out there. You can have a look at your own crypto exchanges. They'll track your equity curve over time as well. Bybit, BitGet, etc. They all do these things. Doesn't matter which exchange you're using. Most of them have some sort of a built-in feature that will track your previous trades. But if you want a more detailed approach, this would be it. You can see each of the trades that have been taken below. You can see the win rate at 80%. The average win was $1,688 with an average loss of $213. That's when going long, right? When looking at short trades, well, you can see the short trades only were 66.67% wins, and the rest of those were losses. Now, the reason that this is important is this tells you which market environment you better trade in. Maybe it's conducive to the trend within that market. Maybe this was a market that's not good for shorting, and that would show you stay away from the shorts and double down on the longs.
He just said something that's really important. I want to go back to it and let you guys hear it one more time. Let's see if I can get there real quick.
It's conducive to the important, and the rest of those were losses. Now, the reason that this is important is this tells you which market environment you better trade in.
This tells you which market environment you are a better trader in. So you have to understand yourself. You honestly do. And you have to understand where your strengths are and where your weaknesses are. In poker, for example, I did not need anyone, any chart, any simulation, any computer to tell me to be aggressive. I naturally took the aggressive lines. So what that allowed me to do was, when I was becoming a better player, becoming a for-profit player, becoming a thinking player, what it allowed me to do was I would give myself reasons to bluff. Okay, cool. I opened from under the gun. I've got a really strong range here. This board hits my range. I've got great blockers for cards that come on the turn, so I can double barrel. I can even triple barrel. I can bluff multiple times. And this is squarely within my bluffing range. But it forced me, knowing myself that I like to bluff, it forced me to say, I am going to make sure that I can justify bluffs, because I know that I might bluff more than I should. So I'm going to make sure that before I bluff, I have a good reason to bluff, not just, here we go. I'm going to empty the clip because I'm some sort of psycho, right? So I knew that about myself, and it helped me become a better poker player because it allowed me to trim off 10 to 15% of my weakest bluffs and utilize those by structuring my range in poker a little bit differently. Similar in trading, you might be a great trader in a bull market. You might be a great trader in a bear market. You might be a great trader on altcoins. You might be a great trader on meme coins, large cap, mid cap, small cap. If you understand where you can be profitable, then you could just focus your time and attention in that sector at those levels. And if you want to get good at other sectors and other levels, hey, I'm not really that strong with understanding how AI coins move. Perfect. Find people who are great there and connect with them. So he just said that. He said, maybe this individual with these stats here, you see the 80% win rate on the longs, 66% on the shorts. Again, it's only 5 and 3, probably too small of a sample size. But what he's saying is you're going to be better at one market than it's possible that you're better in one market than the other. And if you know that, it'll help you be more profitable.
Conducive to the trend within that market. Maybe this was a market that's not good for shorting, and that would show you stay away from the shorts and double down on the longs, because that's where you're ultimately making money. If you go a little bit further down over here, you can see you can add labels, right? What was the trading strategy that you looked at? A support break, a retest, a resistance break? Were you looking at a swing failure pattern? There's various different things that you can look at.
We are going to know what all that means soon
to see where you went right and where you went wrong. So this will automatically actually showcase where your entries and exits were on each of the trades to make it visually pleasing. But as mentioned again, whether you're using a manual or an automated approach, the most important thing is this. You want to see your account balance and your profit accumulated over time moving upwards and to the right, a rising equity curve. Now that you understand the importance of knowing your numbers, you understand the importance of thinking in probabilities when it comes to the risk to reward ratio, we're going to go on to the next video, which I would say is actually the most important thing.
I like a manual. I like a manual sizing, or sorry, a manual.
Everything in risk management.
Hold on, we've got 4 more courses here, so I'm gonna try to. And one is staying safe online with NordVPN. that might be a way to try to get us to buy NordVPN. Use whatever VPN you'd like. It's definitely a benefit. But oh, and there's a quiz at the end. Oh my God, guys, we're gonna be loading up sharpening our pencils, making it happen. I find tracking trades manually, whether it's with pen and paper or via Excel, which is how I do it, is more beneficial for myself, because when I write it down, it really like forces you to sit and think with it. Whereas when it happens automatically, it's nice to be able to see what's happening going up and to the right. But in terms of like your graph, hopefully, but the things don't stick. You don't like learn as much, in my opinion.
Down to this exact video. So let's start off over here with this chart. This is your risk to reward tool. We're going to extrapolate a lot of valuable information from this risk to reward tool here. And then we're going to start to plug in the details, which will show you exactly how much money you should be committing into each trade. Keep in mind that most traders are going to be risking between 1 and 2% for each trade that they take. The reason that they're only risking 1 to 2% for each trade that they take is if they lost 10 trades in a row, that means that they're going to lose between 10 and 20% of their account. Now, remember what we covered in the previous lessons where we spoke about the drawdown death trap. It's very unlikely that a trader that knows how to do technical analysis and read the market is going to lose 10 trades in a row. But let's just say, hypothetically speaking, if they did, well, they would still be okay, because losing 10 to 20% of your account still puts you in the realm of possibility of recovering your entire account. So with that being said, let's consider this example. We're having a look at Bitcoin over here for a potential long trade, which is coming off of a bullish broadening wedge formation. So we're expecting that price is going to bounce off the lower boundary of this trend line, and we want to start to target towards the upside liquidity, which is overhead. The technicals behind why I'm taking this trade is not so important. What's most important over here is thinking probabilities and have a look at the trade setup. As it currently stands, it's written on the risk to reward tool over here that we're busy looking for 3.69 to 1 risk to reward ratio trade, which means for every $1 risked, I'm looking to gain 3.
So very simply, you can see it in the size of these boxes. He's done it in a very visual way for us, obviously, to be able to see. And this is something that we kind of look at here. When we're correct, we're hoping to be correct, that we'll be able to hit our risk to reward ratio. And he said it, for every dollar we risk, we look to make 369 in profit. And obviously when we lose our $4
in profit. Now, what you want to do is you want to go through to this site over here, bettertrader.com. We'll link everything below for you so you have all the information. Now,
yeah, I'll share this.
What you need to write over here is your full trading balance. It's very, very important that you separate your accounts. You should know which account you're using for leverage trading, which account you're using for swing trading, and which account you're using for spot trading. If you're confused by that, simply pause the video and Google what spot trading, swing trading, and leverage trading is, and then revert back to this video.
Spot trading is you're buying and holding on spot, meaning you're just like going to the market and saying, I'm going to buy Brett today and I'm going to hold it until next month because I think it's a good price. Swing trading is I'm getting in and out of trades with a high frequency. Your swing period could be different, but usually your swing trade is I'm buying low to sell high over a shorter time frame. And then on the leverage side, you are actually putting in $1, but that dollar is getting amplified by some amount. Kind of, it's not necessarily options trading, of course, but it's amplifying itself through like Bluffin. You could have the option to, do I want 10x leverage or 100x leverage, and it'll amplify the move. So if something moves $1, if you have 10x leverage, if it moves 10% up and you're correct, you get actually 100% of a return. So those are the three just very quick back of the envelope.
Now that we have that out the way, let's consider the following example. Let's pretend that you're trading with a $10,000 trading account. So your account is $10,000. What you want to write here under full trading balance is $10,000, right? 10,000. The stop loss percentage is the exact trade that you're specifically looking at. How far away is it from the entry to the stop loss as a percentage? So we'll go back to this over here, and if you zoom in,
oh, interesting, it's like 3K
for you to see. If you measure from the
it's like
entry
7%.
price we're looking to enter over there, if price comes all the way down over here, it says it down there, it's 6.24% away. Or alternatively, you can literally use your measuring tool, right? If you use the measuring tool, there we go, 6.24% away. So you go and you write in over here 6.24%, right? There it is. $10,000 account, 6.24% away if you get stopped out on the trade. Now, risk level. As mentioned, most traders are going to be risking 1 to 2%. I've explained why. One thing that I will tell you is that as you become more and more proficient in your trading and you garner a better understanding for your hit rate or your success rate in trading, remember that's covered in the win rate video, then you can start to increase the risk. For example, I often risk up to 5% on a given trade because I know that it's very unlikely for me to be wrong on a trade idea more than 3 or 4 times in a row. So for this example, let's use 1%.
I have thoughts on that. I'm going to let it roll though, but I do have some thoughts on that, especially as it pertains to decisions under uncertainty and your specific circumstances.
You're risking 1% of $10,000. How much leverage are we using? This is where you have a major misconception when it comes to trading. The leverage is not that important. The only thing that's important is the allocated risk, which is 1%. And I'll use multiple different examples to show you why. For this example, let's say we're using 5%. If you're confused, don't worry, it will make much more sense when I go through the second and the third example. So we have a $10,000 account. The stop loss is 6.24% away. The risk level percentage is 1% because we're risking 1% of the $10,000 capital. The leverage we're using on the exchange is going to be 5x, and now we click calculate. If you said that 1% of $10,000 is $100, you would be correct. So the calculation results will print on the right hand side. As you can see over here, point number 2 says max loss. That means no matter what, you can only lose $100. It shows over here the total position size, right, in dollars. It's $1,602.56. So if you're going long on that trade, you have an option. You can either take $1,602.56 as a spot trade with the same stop loss, and if you're wrong, you will lose $100. Or you can use the 5x leverage trade, and now it shows you your required margin to enter into that trade.
Hey, this tool is really sick. What was he said he's going to link it below, but what tool is it? Did anyone see it? It was like Better Trade 508. Hold on, I'm going to go back.
The only trade idea I've explained, go and you write in over here.
Better Trader. All right, that's pretty cool.
And 6 cents. And this is why
that's pretty cool.
Leverage is not that important.
I like it.
Leverage is actually a risk management tool so that you don't expose yourself to putting too much capital on an exchange. So for example, if you wanted to trade with $10,000, you could theoretically put $1,000 on the crypto exchange so that your exchange risk, in case something happens on the exchange, is only $1,000, but you can trade with the same risk level as if you're trading with $10,000 by using 10x leverage. So let's have a look at the leverage again. Now I want you to focus on the numbers on the right hand side. The only number that should change is the required margin. The max loss should be the same. The total position size should be the same, no matter how I manipulate the leverage. So if I go from 5x leverage to 8x leverage and we click calculate under the same parameters, as you can see over here, total position sizes are the same, max loss is the same, but now you only need $200.32 to commit as margin for the trade. Remember, what is the margin for the trade? The margin is the money that you're giving to the exchange as collateral against the trade. Remember, nothing comes for free. You're essentially taking out a loan. The exchange is borrowing you the additional capital, but your margin is collateral in case the trade goes against you. They're going to take that money. Now, let's change this down to...
That's what happens when you get liquidated. When you hear people talk about getting liquidated, I'll pause that. when you hear people talk about getting liquidated, it's because that margin that you've provided to the exchange, it's been used up. It's like a pawn shop. If you go into a pawn shop and say, hey, I need money. I need to go pay off this bookie. He's going to break my thumbs, whatever. You go in, you got a gold chain. Here's my gold chain. They say, okay, your gold chain is worth $1,000. That's the weight in gold. We'll give you $400. Okay, here's $400. Now you have to come back and you have to buy back your gold chain in the next 3 weeks. You have to give us our $400 back plus some VIG because that's how we run our business. Or else we are going to sell your gold chain to make our money back. Sure, no problem. That's what essentially is happening. Again, the numbers are a little bit different, but essentially what's happening is if you take out a trade, the exchange will give you the additional capital. However, if you're wrong, then they are going to take up those assets, your gold chain, the $200 in this case, that you put up against that trade saying, I'm definitely going to be right. If you're wrong, that's what they call liquidation. You get liquidated.
Point number 2 and 3 on the right-hand side should remain unchanged. If you click calculate, the only one that changes is now the required margin, which is $534.19. If you have any additional questions or confusion around this and you have a look at this site, Better Trader, and you scroll through to the bottom, it will actually explain the various different inputs below and give you a little bit further details. Make sure you practice with this site over here. Make sure that you use it when you're working out your trading history and you see how profitable you are over time. And then for any of you that have any further questions to this, remember, I will be available for questions at the next live workshop. Now you know the A to Z's of risk management, and if you study this material, I can promise you this automatically qualifies you as the top 1% when it comes to understanding how to navigate these crypto markets, especially from a risk management perspective. Please understand and remember that in order to survive this trading...
Oh man, we're dropping frames. I tried to go to Better Trader to open it up and show it to you guys, and it is not liking that.
It's literally impossible to do without risk management. Nobody out there has a 100% hit rate when it comes to trading, and if they even tell you that they have, I really recommend deviating course away from those types of people. Risk management is going to be the way that you're going
Oh my God, Kyle is my spirit animal. What did he say?
Deviating course away from those types of people. Nobody out there has a 100% hit rate when it...
Nobody has 100% hit rates, and if they claim that they do, I highly recommend that you deviate away from those people. He is much nicer than I am, because I would say you don't deviate away. I would say you run as fast. You don't walk. You run as fast as you can in the other direction. All right, hold on. I just got to Better Trader here. I'm just checking it out for all of us. And I'll put it in this trading section. We'll play around with this a little bit later. I'll make some tweets about it too. I think I accidentally just signed up for a newsletter or something like that. So shout out to them. They got it.
And if they even tell you that they have, I really recommend deviating course away from those types of people. Risk management is going to be...
Did he just throw shade at someone? Hold on, sorry. Now I know I'm getting distracted, guys. Hey, in school, I was the ADHD kid, and after an hour, I, like you, probably am twiddling my thumbs. I need a fidget. But he said, is he throwing shade at another account?
Hit rate when it comes to
Did he just unsub from someone?
Even tell you that they have...
Pro Trader? Is this shade at Pro Trader? Spicy. A little spicy. I like it. Maybe that's fake. Maybe that's not a real account. We got to find out. I'm sorry, guys. I do not mean to derail, but I have to know who I'm dealing with here. Is Kyle throwing shade? Pro Trader. Let's see. I'm just looking. I don't see anything with that, like with that logo or anything like that. Pro Trader with a little up. Okay, so maybe it's a fictitious person. I was hoping that it was like Dave Ramsey's course or something like that. I'm just looking one more time here. Pro Trader accounts. No, okay. Hey, if that was an actual course that he was beefing with, that would have been extremely bullish. Still a great guy.
I really
That would've
recommend
been pretty cool, though.
deviating course away from those types of people. Risk management is going to be the way that you're going to not only survive, but thrive. But it's not enough. So in the next videos, we're going to cover some very valuable tools that will help you to secure the finances that you're about to gain over time. I'll see you guys there. I know that you're probably hoping this is the part of the course I've been waiting for. This is where we're going to get into the strategies and have a look at the chart.
Okay, you guys, it's been about an hour. I think that my attention span is starting to waver. I'm looking up fake beef with Kyle and Pro Trader. So I think that this is a good place to pause. We are going to do this again tomorrow, and we'll still pick up right where we left off. So we're learning about risk management. We've learned quite a bit today. I actually, believe it or not, took some notes here, and I think that this is a great place to go over some of those notes. I should probably get it to where I can share it so I can show you guys what some of these notes might look like. I'll do that the next one, but I think that probably the main takeaways here are you are looking for an opportunity when you're managing your risk to not only look at the trade, but understand what the risk versus reward is. That's you're managing your bankroll and you're trying to understand what that risk to reward is. So every time you enter a trade, I want to kind of go to some of these charts that I thought were really valuable. Let's just mute some of this stuff. Some of these charts that I thought were really valuable. These are concepts that I think are going to be very beneficial to anyone who is looking to become a successful trader. You want to be able to understand that when there's a drawdown on the asset, you need much more than that drawdown. So if you enter into a trade and there is a 10% tax, you immediately need the asset to go up 11% just to make your money back. I see ASAP, man. ASAP, thanks for joining in. He chatted. So I was just giving him a chat back. But like, these are things that people don't think about. I've met people when they're talking about, I entered into this coin. I bought it at $1 million. Now it's at $3 million. And they buy it and they sell it and they look in their account. They're like, wait a minute, what? I'm only up 2x. I should be up 3x. It's these hidden costs that you're not really paying attention to, that you're not noticing, that you're not seeing. And it's similar to what's happening here, because that's when you pay a tax, that's a loss. I hate taxes. Pay what you owe. FBI, IRS, whoever you are, don't come for me. I pay it. But this is an important thing to understand. So if I were to kind of summarize the key concepts for today before we go into tomorrow, it is bankroll management, making sure you're not risking too much of your portfolio. It is going to be how to understand and track your trades. So you track your trades to become a better trader, to understand your win-loss rate, and then the size of those wins and losses, which will help you come with your fifth thing, which would be sizing your trades effectively. And we had some cool tools that will help with that. So you guys, I just want to say thank you. This was kind of, I'm going to say on a whim, because I've been trying to set something like this up for a little bit. Been talking to Crypto the Kid. Big shout out to Crypto School and the Crypto Banter people for helping, to get this set up and allowing us to go through the course and share it. So we're going to go through how you can really sign up for their courses as well. So you can do this with me. But I do want to say, guys, thank you guys so much for watching. We will be back at it tomorrow. Same time, same place. We've got a lot to get through. We didn't even get through course 1 because we stopped and talked so much. But we're going to wrap this one up. I'm going to go back to the drawing board. We're going to make sure that we keep pushing. But this has got me very excited about trading, and I hope it's gotten you excited about trading too. So all that being said, stay safe out there in the crypto streets, and I will talk to you guys on the next one. Peace out, all.